My name is Jamal Chandler, and I am here this morning to discuss with you a new way to hedge using ratio spreads, okay? And quick little background on myself. I traded for 8 years for a proprietary trading firm, traded 2 years on my own. Prior to all of that, I also traded stocks. So I was always looking for different ways to learn. Now, I went the route to work for a trading firm, but you can also, I would venture to say there wasn't as much opportunities to have as much education when I first really started to get interested in options trading. So I think it's great that you guys are taking advantage of what's put in front of you. Our disclaimer slide here. I think there's a lot going on here, but the bold is always interesting, and I'm pretty sure Ed probably touched on these too. But options do involve risks. For those of you, there's a lot of you who have seen them traded, and probably at home too, that seem to have traded a little bit already, so you're aware of these risks. I think, to quote one of the great shows that I loved growing up, G.I. Joe, knowing is half the battle. Maybe you watched it, maybe your kids watched it, maybe it annoyed you hearing that music every day, but knowing is half the battle. You got to know your risks for your rewards. I think you're aware of that in everything else in life. Don't expect any different with options and trading. A lot of the examples that we're going to go through today, they're just examples for educational purposes. They do not necessarily include commissions, fees, those type of things that you need to pay attention to as well, so just so you know. The mission of the OIC is simple. It's free, unbiased, and professional options education. And you can get a lot more information via the online courses, the podcasts, and things of that nature on the optionseducation.org website. So today we're going to go through a few topics here. First, we're going to touch on traditional hedging and position management. You got a little bit of taste of that today from Ed. Then we're going to cover ratio spread trading. Then we're going to talk a few examples here. First will be the put ratio back spread. Raise your hand if you understand what a back spread is. Raise your hand at home. Let me see. No, I'm just kidding. Raise your hand. OK. When I got into business, I didn't know what a back spread was. I started as what you consider the upstairs trading type of people. And the floor guys would love to mess with you with the idea of back spread and front spread. Back spread, the idea behind that is just when you're typically long more options than you're short. And front spread is when you're short more options than you're long. So try not to confuse you by using the two between. If you don't understand, but I'll try to make sure I make the distinction and help you, make that clear. Then we'll talk about stock repair. And finally, we'll wrap up with some Q&A. So traditional hedging. For those of you who are unaware, maybe here at home, the idea is that when you have long stock, you look for something to hedge that, or the idea of a long put, protective put, so that when the stock goes down, you'll still be able to either profit a little bit or not lose as much on your long stock. Okay? You also have the idea of a bear put spread when you have long stock. And again, a lot of these ideas are from long stock because the idea is that generally we have long stock buyers in our market, right? So when you have long stock and you have a long put spread, that's a situation of when you have a one put that you've bought and a further downside put that you're short. So your ability to protect yourself is capped because of that short put to the downside, but you still have some protection when the stock falls. And then finally, you also have the idea of an options collar, right? When you're short call, long put, that's a situation where you're protecting yourself from downside move, but you might be also limiting some of your upside. Now, some people are fine with that. Having that short call limiting their, some of their upside potential. Maybe they have a sizable gain on already. So it just varies, depends. But these are all great traditional hedging methods. So today we're going to talk about what is a ratio spread. Well, the best way to think about it, for example, we just talked about a put spread, right? 1-to-1. One put you bought, one put you sold. That's the normal idea of having a spread, or like a put spread, or say one call you bought, one call you're short. That's 1-to-1 ratio. In this situation, we're talking about, for example, buying 2 calls and selling 1 other, okay? Or buying 2 puts and selling 3 others. So you're doing things on different ratios. The reason being you may want to keep a different eye on volatility or keep a different profile. They have different trading P&L profiles to those that you'll take advantage of. So AKA the front spreads or front or back ratio spreads. Those are things that we're talking about when we're talking about these ratio spreads going forward. So you'll see here we have 1-to-2, 1-to-3. You can put them on in a multitude of different ways. So why would you use a long ratio? Well, they may provide downside protection for an existing long stock position, okay? While also affording you the ability of having unlimited upside price appreciation. They can often be put on for, a little cost or maybe even a credit, right? So when you're buying, say, a put spread, you're paying for that a little more. Versus when you do a ratio, you can probably maybe even close to collect money to put something like that on. And then you can benefit from the move. If you get more of a sharp move, say to the downside on a ratio spread, you can benefit once it actually moves in the direction if you want. But you're not necessarily losing money by it's just sitting there being long that put spread. Okay? And generally they're sort of, they're delta neutral. And then they'll move, once you get the move that you want, then you'll start to see it take on a different profile, and you'll get, say, for example, if you'll have a long push ratio spread, which we'll go into, you'll start to see the deltas increase to the downside. So instead of me just yapping about it here, how about I show you what we're talking about? The first example here being a put ratio back spread. So a long ratio put spread, long being back spread, generally, say you sell one at the money put, and then you buy two further downside puts, okay? So downside meaning out of the money. So in this case, put some numbers to it. We're selling one 60 put while buying two 55 puts, okay? So we're long those two puts to the downside. So without shares, you intend to benefit from this trade with a sharp move to the downside. So once it goes through your long strike, okay? With shares, it's intended to kind of offset some of your stock losses with a large move to the downside with little to no cost, because you put this on. You sold one, you bought two that are less. Less in cost. And this will benefit for you when it'll increase in value with a sharp stock drop, or if the price increases, because again, you're long the spread, so it'll increase. If it increases in volatility, that's also good for you. Graphs are always good. I like graphs personally because seeing is believing. So let's say you're short 190 put, long 285 puts. Let's put some numbers to this here. Say you're short this 190 put for $1.25, and say you're long the 285 puts for 50 cents, okay? So 2 times 50 cents is $1, so that's your dollar credit. You sold that 90 put for $1 credit, for $1.25. So as you see, your max profit is that if the stock were to take a sharp move to the downside, say it goes to zero, that would be kind of a crazy move, but it's always interesting to know where you generally make your most profit. I'm sorry if I'm in you guys' way here or at home. Your max risk, as you can see with the red dot here, you do not want it to end at your long strike. For those of you who are familiar with options, anytime you're long an option and it ends at that strike, then that strike will eventually, at expiration, be zero. So that's not what you want in this spread also, right? You don't want it to end at your long strike. As you can see from the graph, we have two break-evens here. One further to the downside. In that case, once it moves, the long put strike minus the difference between the two strikes minus the credit, and the short put minus the net credit. So what does all that mean? Well, the difference between the two strikes is 5. You took in a credit of 25 cents. So that's 475 minus the long strike to the downside. So right there, that's at 80.25, okay? So that's your break-even point at which, once it starts to go further below that, then you start to make money on this spread. And then to the upside, if it moves to the upside, well, you took in a credit. So if everything being equal, both of these options expire worthless, you took in 25 cents, and you get to keep that 25 cents, okay? So why would you use this? As we said earlier, if you're expecting a sharp downside move, or that kind of thing happens, you put this trade on for a credit, so you're good there. You're good with whatever happens. However, you don't want it to end at 85. And if it moves to the downside, you're going to, say you have stock, you're going to lose on your stock, but you're also going to benefit from this downside move that it's taking. So what type of situations does that happen in? Well, if you've done some options trading already, you'll know that, type of earnings reports, sometimes unexpected earnings reports can result in a sharp move to the downside, or drug test trials when, when a drug is not approved by the FDA by some biotech stock. They can move sharply to the downside. Or a legal case. Well, a lot of times maybe the volatility is high going into that event. Legal cases can swing a stock one way or the other, and if you have a large downside move in that, you have this type of trade on, you're sort of protecting some of your gains or protecting yourself. So let's go through a scenario here. Say an investor is long shares from $59, right? And they're looking to protect their downside with little to no cost, without forgoing any upside potential. So some possible strategies here. You could do a protective put, as Ed so greatly laid out earlier on. But that may not satisfy the requirement of the cost, right? You could also do a collar. We talked about collars a little bit ago. But that also limits your upside potential. And again, some people are fine with that. Collars are fantastic, but some people don't like that idea. So this put back spread, well, that checks off both issues on the list here, right? It's cost effective. You put it on for little or no cost. Maybe even you put it on for a credit like we did in our example. And you're also protecting your downside. So boom, checked out 2 boxes right there with this trade. Again, more numbers. Hopefully you like numbers if you're trading options, to be totally honest with you. And I will say this. The thing about, I feel like most of the people in this room are used to it. I have to always try to get my kids to understand this idea of when you pay for something, understand the kind of change you're getting back. Not that they pay with dollars anymore, but understanding simple math is always key with options, right? And the more examples you can do, I saw some of you working on examples here, maybe you're working on that kind of thing at home, like the more examples you can do with the simple math, that's actually what helps you understand more. Once you understand your risks, your rewards, the moves, but also understanding the numbers behind it, it's key. So we got a few numbers here. Long 100 shares from 59, right? You sell your 1 put for 66 cents, buy 2 puts for 66 cents. Where did I get that 66 from? Well, if you look at this offer here, the 58, 33 times 2, that's your 66 cents. That's even money. Sold 1 for 66, bought 2 for 66. Even money, right? So your initial deltas is long 93 deltas. Where did we get the 93 deltas from? Well, then you roll over to your delta. We all know that long stock, anytime that's 100 delta. Options, you're short 7. How are you getting the short 7? Well, you got 28 deltas on those 2 puts that you're long, so that's 58 deltas. And then you got short 59 put that you're 51 deltas on. So that's your 58 minus 51, that's your 7 deltas that you're short. And you're short them because you're long downside puts, right? Simple enough. Put back spread example number 2, if you're hedging stocks. So if you're long 100 shares from 59, you're short that 59 put, you're long those 258 puts for even money, as we discussed, okay? So, this is cool to kind of look at this here to see where you lie. This is another interesting paper example you can do with a lot of different trades to see where you lie along, the curve here when you're looking at your trade. So let's start at 64. You're long 100 shares, 59. Difference between that is $5. So you're making $5 on your stock. The value of your 59 put at 64, 0. And they're taking these to expiration, okay? We're taking this all the way to expiration. The value of your 258 puts, 0. So your net loss, profit loss there is $5. Simple enough, right? You're basically taking the options out of that situation and you put it on for even money, so you didn't make or lose on your options trade. And your stock is $5 up. So simple enough. Let's go to the extreme example, 56. At 56, you're long stock from 59, so you're down $3 on your stock, right? The value of your 59 put, that's $3 in the money. You're short that, so you're down $3. The value of those 58 puts is $2, right? 56 minus 58, $2. 2 times 2, that's $4. So net, even add that up, 4 and 7, you're short, you're minus $3 on your trade, okay? So just kind of, anytime you had that question, whether it's a puts back spread or anything, just think to yourself, take it to expiration. What is the value of this at expiration? Difference between those strikes. Obviously taking calls and puts into effect. What is this value? What is this value? So that's what we're doing here. Simple enough. 58, you're down $1 on your stock. That 59 put is $1 in the money, so that's down $1. The 58 puts, those are 0. So you're down $2. So you know all your risk and all your rewards with this scenario. once again, looking at another graph. So if you're long 100 shares from 59 and you're short 59 put, you're long 2 of the 58 puts for even money, your maximum gain is unlimited because once it goes through that 58 strike, then you start to make money. And another way to look at this is like if you're short that 59 put and you're long 159 put, you're short a put spread, so that's 1-to-1. You have an additional 58 put, right? So that's where you're really making your money on. And so your break even is 59, as we saw in the previous graph, okay? So now let's give the call some love. We've been giving the put some love. Let's give the call some love. Let's talk about a call ratio front spread, okay? So a short ratio call spread or front spread, generally the investor buys one at the money call and they're selling additional, or in this case we're talking about 2 out of the money upside calls, okay? Upside, out of the money is generally the same thing. So in this case we're going to put some numbers to it. Let's say we're buying 180 call and we're selling 285 calls, all right? So without shares, you're intended to profit from this if you have a move to the upside, but not a strong move that goes to your short strike, okay? So we're looking at the idea of shortly range, like a sort of slowly range-bound stock that's generally moving up, but not moving up huge. And then with shares, it's kind of intended to offset any losses that you may have in a stock, right? By lowering your break even, okay? Lowering your break even with little to no cost. So you have increases in value with that, with moderate share price. And I like to move around. I'm sorry. This is bugging you. It's not bugging you, is it? We have increases in value with your moderate share price and increases with decreasing implied value. And most times when stocks are going up, especially if they're going up slowly, implied volatility is decreasing and coming in. So that's another reason why this is a trade that people will look to maybe put on to have the short 2 upside. So looking at the graphs once again, you have a long 80 call, you have 2 short 85 calls, and we've put this trade on for a credit. This is awesome if you can put it on for a credit. You might always get this, but this is fantastic. The great people at OIC are hooking it up for us. So you have max profit is the difference between strikes, once again, plus or minus the net debit or credit. And always keep in mind, when you take in a credit, if you're able to put this trade on for a credit, then you can take that off of your break even, and it kind of lowers your break even. In this case, it lowers your break even to the upside. So instead of a situation where before we had a further down break even, this case, because we're short 2 upside, our break even is going to be $90.25. So that once it gets to that point, that's when you'll start to lose money, okay? As you see, and then once it starts to go further up, then you have your max risk is unlimited due to that extra short call, okay? So again, one way to also look at this is you have a long call, short call, 80, 85, and then you have an additional short call on the upside. That's why you have that unlimited risk to the upside, because you're just short call basically naked to the upside. Your break even, short strike, plus the difference between strikes plus the credit received, okay? So typically, in this case, typically, as you can see, we put it on for a credit. So if it goes down, well, then you keep that credit. That's the 25 cents that you keep there. So if it falls down, you're not losing anything on that. You're keeping the money actually. And typically, you'll employ a call front spread for those who are expecting a steady uprise in stock, as we said, and you're hoping that the volatility will come in as it's going up slowly. Okay, so you'll get to sort of, if the best case scenario is if stock ends at 85, right? Right there at 85, not only is your 80 call worth $5, this 80, whatever you sold the 85 calls for goes to 0 at expiration. So that's your best case scenario. You would love for stock to end at 85 on this front ratio call spread. So the idea of a stock repair strategy, well, what is that? Well, your ratio, spread using the calls to lower the break even. You're using this ratio spread to lower your break even on a stock that you may be losing on already, right? So why would you want to do this? Well, you're looking to forego any potential, long-term profits, and you're don't want to necessarily commit any more money to a losing stock, right? So this is kind of a lower cost effective way to sort of, maybe if the stock starts to move up again, you don't have to commit, the whole amount of money to the stock once all over again, right? You could, if it's not working that way, you could hold and hope. How many of us have done the hold and hope strategy? I think this stock is going to bounce back. I'm just going to sit here and wait. I don't want to, get out of it. I believe in it. You start having that discussion with yourself. Do I want to buy more shares? Do I want to put up more of the money? Well, you could look to do something like this, call ratio front spread, right? That's going to reduce your overall break even, and it gives you the ability to kind of do what you want to, because once it starts to go back up, it'll start to slowly go back up, and you'll start to believe again, and you didn't commit the full amount of stock you put on this call ratio front spread, and you look smart doing it. So let's talk about a scenario here. Say you're long 100 shares from 65, right? And due to some recent market action, say the shares are trading 57 now. So you're losing $8 on that. And you're trying to recoup some of your losses. Get a little drink here. By the way, if you're ever talking, it's best to drink tea. So what I've heard, tea is better. Not water. Water constricts your throat. Possible remedies. Investor. You can stay long, stay the course. You can do the hold and hope thing. And hope that it rallies back, right? Or you can purchase additional shares at 100, laying out $5,700, and you can do the dollar cost averaging thing, so that will reduce your per share to $61 per share, but you have to put up that extra money, right? A lot more versus doing this call front spread, right? Especially if it's a situation where you can put it on for even or put it on for credit, that's a scenario where you will be able to kind of still have the same mindset, mind frame of what you want on this particular investment and trade, and hopefully it starts to go back up like you expected, like you already know, right? So going back to the numbers. You're long 100 shares from 65, as we said. Stock is trading 57. You buy the 57 call, so you're buying an at-the-money call for 96 cents, and you're selling 2 61 calls for 48 cents. So when you do that, that's your 96 cents also on the 2 calls you sold. So in this case, we just did it for the one side. When you sell the 268 calls, you see the market here is 47 and 50. So you sold a penny off the bid. You sold them for 48 cents. You sold 2 of those, so that's 96 cents. So in this case, that's even money, okay? And your initial net deltas is long 99. Stock is long 100 deltas. Looking at the deltas here, you see your long deltas for 37. I'm sorry, your long 53, your long delta is 53 for your 57 call, and your short delta for the 26 calls is 52. 26. 26 times 2 is 52. So your net short 1 delta on that option trade. So your long deltas overall is 99, okay? So you haven't taken too much off the table as far as your delta initially on the trade. You guys still with me? Everybody good? Okay. How about at home? Pajamas on? Nice. So, long 100 shares from 65, long the 57 call, stock is trading 57, and you're short 2 61 calls for even money, okay? As we discussed earlier. So let's look at this the top scenario here. If stock is, let's go to the stock at 57, okay? Because that's where we're initially doing this trade at. If stock is trading 57, like we said, you're losing $8 on your stock. The value of the 57 call at expiration would be 0, right at the money, so let's just assume that that's 0. 61 calls will finish out of the money. Those are 0, so your net overall losing $8 on the trade, okay? 55 calls, say the stock goes even lower. And again, we put this option front spread on for even money. So it goes even lower. At that point, the only thing you're losing on is your stock. Stock is down now. We bought it at 65. Stock is down now $10, so we're losing $10 per share. The value of 57 call, it's out of the money, so that's 0 at expiration. The value of your 61 calls is 0 at expiration. So you're just losing on stock there, and you're down $10. What about at 63? So at 63, if you're long shares from 65, difference between that is $2, so your stock P&L is down $2. The value of your long call, well, now that's in the money. And so you're long that in the money 57 call, and that's $6 in the money. So you're up $6 on that. At 63, those 61 calls that you're short are $2 in the money, and the 2 times 2 is $4. So net overall, you're net out 0. So the stock has rebounded. You're glad about that. And you put this trade on for even money. You're not losing there. And now you just are looking at, you've recouped some of the value of your stock, so you're happy. And now you just want, if it continues to go up, that's where you have your risk. But you also are making money on your stock from there. So you're short one additional call to the upside while you're long your 100 shares of stock. Now, at some point, that could get called away. But ideally, what you would love is if it finishes at 61 at expiration, which it could at some point in time. You never know. So as we see here, this is a situation, again, you put this trade on, not for maximum gains, but you put it on so that you can dollar cost average in a different way than just laying out another $5,700 because your stock is down $8, okay? So the profile on this doesn't look as fantastic as, say, the other ones that we looked at. But in this case, you were putting this on with a different mindset. You're saying, I'm hoping this stock rebounds, and I don't have to, I hope the stock rebounds. I don't have to put out another 100, I don't have to buy more shares. I'm dollar cost averaging in a different way, and now the stock is beginning to continue to rebound. So you put it on for even money. Your maximum loss is substantial, but it's the same as having a long stock position, right? That maximum loss is substantial as well. And your maximum gain on this is a break-even trade. Sometimes you got to break even. So your break-even is 61 in that sense that once it's at 61 at expiration, then that's what you would like out of it. You don't want it to go above that. But still there, you're down 65. You're down from your 65 where you purchased shares. So you're still down on your original long stock trade, but now the stock is recouped, and you're glad that it finished at 61. So some things to know. The put ratio back spread. So without shares, you're intended to profit from this trade from a significant decline in stock. So if it's bearish, right? This is a trade that you put on where you can put on for little to no cost, but once the shares start to move down significantly, then you're hedging your stock losses. So you would like a large downside move on this, on that trade. If you have shares, you don't necessarily want a large downside move, but this protects you with a large downside move, and you put it on to little to no cost. Call ratio front spread. So without shares, it's intended to profit from a sort of range-bound stock that's going up slowly that will finish at your short strike, okay? Slightly bullish, but not overly bullish, because if it goes up too far, it goes to your short strike. With shares, it's intended to offset your stock losses by lowering your break-even for little to no cost. There's a lot of things that you can learn here, and you can go to the website and get a lot more information via podcasts, via the videos, and so attending live events. And that's our wrap-up. So thank you for coming today. We have a lot more information at theoptionseducation.org, and follow on YouTube, like all. Oh, thank you. Stop it. Come on. Thank you at home. Thank you for joining us. Hope you still have pajamas on. I know I would too. Thank you very much.